Welcome back, everyone. I'm Kirill Fly, investment analyst with a decade of experience. Here we connect dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Today, I want to talk about two things. Fast the Fed. Last episode, recorded the day before the meeting, I told you we were at peak hawkishness. The meeting happened, and the projections from the governors came in slightly more hawkish than I expected. I'll give you the honest scorecard and then make the case that the bond market and the inflation data are on my side, not the hawks. Second, the AI trade. The split I described earlier this year is playing out. The companies doing the spending keep underperforming, while the companies they spend with keep winning. And a new model out of China just told us something important about where this whole race is going. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but you always do your own research.
This video was created in collaboration with the IT company Anderson.
Let me start with the Fed. Last episode, I told you we were at peak hawkishness, that the most hawkish outcome was already priced. And I leaned toward the view that it would be hard for the new chair to come in more hawkish than the market already was heading into the meeting. I also gave you two risks to the view. One was oil spiking again. The other was Fed surprising hawkish. So oil kept falling, so that risk is behind us. But the second one partly came true. The projections were slightly more hawkish than I expected. So let me walk through exactly what happened and why I still think the underlying call is right for now. So this was Kevin Warsh's first meeting as chair, and rates were left unchanged, as expected. The first noticeable change was this statement itself. It was cut down to the bare essentials and leaned on one line, that the committee will deliver price stability. Now, that is the single most standard thing any central banker says. They all say it all the time. So the words were not the story in my view, even with all the commentary out there about them. What I think moved the market was the dot plot, the projections where each official pencils in where they think rates are going. Now, here's what the dots showed. The median official now expects one rate hike this year. Back in March, that same group was leaning toward the cut. And back then, oil was up around 120. Today, it is back to 74. It's already questionable. And then, having hiked this year, the median shows them cutting next year, right back to where rates are today. Just stop and think about that. You hike once and then you turn around and cut almost immediately. That is not a policy path. Central banks do not hike and then unwind it just months later unless something has gone wrong. It is incoherent. And to me, that incoherence is the signal. It tells you this is a committee that does not actually have conviction. And the most telling detail is that Warsh, the chair, submitted no dots of his own. He let the rest of the committee fill in the page. So those projections are coming from the other members, several of whom may not even vote, while the person actually running the institution declined to endorse the path and signaled he did not see much conviction in the room either. So when I read the median, I do not read it as a plan to hike. I read it as a committee who has no real view, defaulting to caution, while oil was still elevated when they set these forecasts. So yes, this was a touch more hawkish than I expected, but here's the important part. It looks like the market is overreacting, getting too far ahead of itself on the hawkish side. For example, watch how the bond market responded. The 2-year yield, which is part of the curve most sensitive to what the Fed actually does, jumped on the meeting. from around 4.05% the day before to 4.2. That makes sense. The Fed got more hawkish on paper, the front and the prices. But then the 10-year did the opposite. The 10-year never made a new high. Its peak was almost 4.7%, and that was back on May 19th, days before Warsh was sworn in. Since then, it has stayed well below that, sitting around 4.45. So the short end popped, and the long end refused to follow. The long end is telling you that this hike, even if it happens, is bad for growth, and it is not a sign of a hot economy that needs cooling. And it's not just the bond market. The actual inflation signals back me up too. Oil, the thing that set off the whole scare, has round-tripped the entire war premium. And the market's own inflation expectations have done exactly the same thing. The one-year inflation swap, what the market prices for inflation of the next year, spiked to around 3.5% at the height of the war, and it has now collapsed back to 2.4. The two-year inflation swap is right there with it. So the near-term inflation the market was panicking about has completely round-tripped. We get the Fed's preferred inflation metric, PCE, on Thursday, the day after I record this. We'll see where it lands, but keep in mind it's still May data, so it still carries elevated energy. And the thing to watch is how the core inflation behaves underneath. So I'm comfortable looking through this hawkish meeting. As the June inflation data comes in over the next few weeks into mid-July, I think the market comes back in line with my view of the path, not the Fed's does. And it's worth noting that over in Europe, the ECB's Christine Lagarde struck a much more balanced tone this week, flagging no real second-round effects from the inflation spike and the growth picture that is weakening. So I read that as them trying to play things down a little. But let's see how it plays out. There is one thing that does worry me, and I want to be honest about it because it is the variable that could change my stance, the dollar. Dollar index has broken out above 100, a level that it has capped for the entire year. And it is now around 101.3. The stronger dollar tightens global financial conditions and works against risk assets. So I'm watching it closely. Now, two things make me hesitant to overreact. There is not much conviction behind the move yet. And frankly, I do not buy the central bank hawkishness thesis, as I explained earlier. And positioning is already very bullish on the dollar, which usually caps how much further it can go. So for now, I'm not changing anything, but if this breakout holds and extends into next week, that is my signal that we may need to pull back the risk on stance. That is the single variable I'm watching to tell me where risk assets go from here. Now let's move to AI. Earlier this year, I made a call on how to play the AI theme. I said the company is actually doing the spending. The big hyperscalers were not the best place to put your money. The logic was rather simple. They're committing an enormous amount of capital to build this out, and the market has real questions about whether the returns will ever justify the spend. When a company is pouring hundreds of billions into something with an uncertain payback, the market eventually starts to discount it. These companies used to generate huge free cash flows. Now, for several of them, it is deeply negative. There is a big transformation for the market to digest, and on top of it, some are now issuing equity, their stocks, to help fund the next leg of capex. And year to date, this is exactly how it has played out. Look at the spenders. Microsoft is down about 21% this year. Meta is down around 13%. Oracle is down about 15%. Amazon and Alphabet have held up better, up a few percent. Google's parent is even up 10%. But overall, that is the market punishing most CapEx spenders in real time. As a group, the spenders have badly lagged the broad market, which is up around 10% this year. Now, look at the other side of the trade, the picks and shovels, the companies that sell into this build-out, semiconductors, especially the memory makers, plus the foundries and the chip makers. The semiconductor index is up roughly 108% this year. That has been almost the only trade in town. While the spenders went nowhere. The suppliers nearly doubled, led by memory on the back of surging demand for AI data centers. So the spending is real, the build-out is real, but the way to own it has been the suppliers, not the spenders. Their CapEx is your opportunity, basically. So I'm reiterating that call, stay with the picks and shovels, stay underweight the hyperscalers. Although I will say that some names in the semiconductor space are now clearly looking frothy, so be selective. Now, let me be clear about what would make me change this view. The first sign I'm watching for is the spending itself slowing down. When the rate of growth in their CapEx starts to roll over, that is the signal. Or the other side of it, when these companies show a real sustainable improvement in profitability from all this spending. Until one of those two things happens, until they stop spending or start clearly earning and return on it, I stay with the picks and shovels over the spenders. Now the big development, and it came out of China. A lab called ZAI released a new version of their model called JLM. And it is an open weight model, meaning anyone can download it and run it themselves. And it is very close to the frontier US models from Anthropic and OpenAI. And it does that at roughly 1/6 of the cost. Huge news. That matters because so far the consensus has been built around the assumption that open models and Chinese models specifically would lag the Western frontier by a wide margin. That assumption is not necessarily wrong yet, but the gap is closing. And it is smaller than most people think. It is not a year, and it's not even 6 months. The level of intelligence this Chinese model has today, the top US model only reached back in early March. So the entire lead is about 3 to 4 months, and it's still shrinking. ZAI's own leadership says they expect to match the very top model of Anthropic by the end of this year. The number itself is not the scary part. The scary part is how fast it is closing. You can see it from the chart here. Now connect this to what we covered last episode. Last week, we talked about the US government putting expert controls on Anthropic's frontier model, walling it off from users outside the country. At the time, I framed that as government treating AI as strategic national infrastructure. This week, we got the other half of the picture. Hard proof that the Chinese are not sleeping and are working hard to close the gap. Put those two things together and the conclusion is quite clear. There is no longer just a race between companies. It's a race between states. And once it is a race between states, with the gap measured in months, nobody can afford to slow down, because to slow down is to lose. So I expect the US government to keep the capital flowing, both to the model labs and to the hyperscalers that built for them. Nobody in this race gets starved of funding. And here is where I think it ends up. because the capability is getting genuinely powerful. I think we're heading toward direct government involvement in the frontier models themselves. Not today, because the government ownership would slow the private labs down, and the US does not want that. But later, into 2027 and 2028, I would not be surprised to see the government take control of a frontier model outright. Because at some point, the capability becomes too strategically important to leave entirely in private hands. There are already reports, and I will flag this clearly as press rumors, that Mythos is powerful enough to break NSA-grade encryption in a matter of hours, and that the next frontier model is close to ready. Treat those as unconfirmed, but the direction is what matters, and the direction is toward the state. And before I wrap up the scoreboard, as always, this is the running tally of every call we have made on this channel. So as you can see from the table, we're slightly higher versus last week. So to pull it together, the market read the Fed as a little more hawkish than I think it really is. The dot plot does not hold together, and every market measure of inflation has round-trip the war. So I stay risk on, and the one thing I am watching that would change that is the dollar. On AI, the trade is split in two, and I stay with the picks and shovels over the spenders until the day their capex growth slows. And the Chinese model this week is the Tao. That this is now a race between governments, which means the money keeps flowing into the whole build-out. That's it, guys. If you got something out of this, hit subscribe and like, and I see you next week.